The government remains open, and it is now the stage is set for a massive bipartisan two-year budget deal that increases defense spending and now suspends the debt ceiling until March 1st, 2019. The government was shut down overnight for about 5.5 hours until the House voted this morning at 5:30 a.m. for another spending bill. Joining me right now on the telephone is Invimed Associates Chairman and Home Depot co-founder Ken Langone, watching these markets and the developments out of Washington. Ken, thanks so much for calling in this morning.
Thanks for having me, Maria. How are you today?
I'm great. You've said in the past, Ken, that this kind of ballooning debt is unacceptable. So give us your take in terms of what went down in Washington last night, what it's going to take to get Congress to pull in the spending, and why it's so important to markets.
Well, I don't think you'll ever get Congress to pull in spending. It's not their nature. I believe, Maria, that the thing that excites me is we're starting to see a movement in interest rates up to levels, hopefully, that are more realistic than we've experienced in the last 8 or 10 years. To have the cost of money be as low as it was creates, in my opinion, distortions of the markets. Frankly, I am much more comfortable today, believe it or not, with the markets where they've been battered this past week than I was 2 weeks ago today when the market was hitting new highs, because it didn't seem to make any sense that stocks were going up in the face of rising interest rates. So, number one, I hope the Fed stays the course, because if it does, I think we'll get some more rational behavior than we've had here in the past, immediate past. So rates have to go up, and they should go up. I think the stock market got ahead of itself. I think it's a simple formula for me. I study my companies. I know them. I stay on top of them. I'm a long-term investor. I think over many, many years, I'm going to be well rewarded in the American economy and American companies. And I guess these different mechanisms that have been created over the years to try and get people to get an extra 2 or 3 or 4 or 5 basis points of performance, in my opinion, is nuts. And we're seeing the unwinding of some of this stuff. But to me, the underlying reason for the market is we're finally coming to deal with the reality of higher interest rates, and I think that's good.
And you think it's good because we've been in an artificial place for so long, the Federal Reserve pushing rates all the way down to zero and creating all of these opportunities that you talk about, which were sort of bubble situations. But what's your take on the interest cost on the debt, Ken? Because isn't that one of the issues for markets today? The fact that rates are going higher just at the time that we're talking about trillion-dollar deficits, Ken.
Maria, if you do simple math, if we got $20 trillion in debt and interest rates go up 200 basis points over the next 2 or 3 years, you're adding $400 billion a year to your federal budget on the expense side. But I think it's got to happen. Now, I think there's a good chance that equity markets are going to have to adjust to this. And, of course, I think also we're going to have to come back to the reality of inflation again. Prayerfully, it'll be orderly, and prayerfully it'll be within a range that won't create distortions, unlike the late 70s. But we've witnessed here over the last, and I can understand people rationalizing these past 10 years based on the crisis we had 10 years ago. We're beyond that crisis, and now we've got to get back to normal behavior. Normal behavior, in my opinion, are interest rates higher than where they've been over the last 5, 6, 7, 8, 10 years.
Yeah.
I mean, if you go to Europe, effectively, in some countries, you were paying them money to hold your money.
Right. Well, sure. They had negative rates. Yeah, they had negative rates in Europe. Absolutely.